Hi, this is the second quarter 2022 update for the Bell Global Equities Fund. I'm Adrian Martuccio, the co-portfolio manager of the fund. Equity market volatility continued in the second quarter, although that was dampened by the weakness of the Australian dollar. So the MSCI World ex-Australia benchmark fell 8.4% in Australian dollars. When we look at some of the macro factors more broadly, there have really been few hiding places in 2022. The first 6 months of the year has seen the MSCI World Index decline by 20.9%, which is the worst 6-month period first half in its history. Inflation has driven up interest rates, and a commonly watched benchmark is the US 10-year Treasury yield, which has doubled to 3% this year, up 150 basis points, which is the highest first half increase since 1994. Inflation's remaining stubbornly high. We've seen recent numbers out of the US, 9.1% CPI for June. Europe is at a similar level, 8.6% as well. We do expect inflation to abate later in the year and into 2023, but for now it will stay high. Fortunately though, consumer spending has stayed strong. The labour market is very good. Wages have been rising, and the balance sheet at the household level is very strong. Although the consumer wallet is being squeezed and they are using up that cash, so there may be some weakness in the second half of 2022. When we look at the GDP outlook at a global level, expectations are for 3% growth now. This has declined from 4.6% at the start of the year. Although we're seeing reasonable levels of growth, if we adjust this for inflation, real growth levels have been negative. And it's this lack of real growth that makes the position of the central banks so difficult as they attempt to control inflation through rate increases. In many cases, the operating environment that we're in today hasn't been seen for decades. I was recently travelling through the US, and a great anecdote that a CEO mentioned to me was that the world has got harder, and anyone telling you otherwise is a liar. And the environment over the next 6 to 12 months will clear the decks of the pretenders. We see this inflationary environment and the general uncertainty as an excellent time for active stock pickers such as ourselves to be rewarded, especially in the quality space. As a reference, over the last 40 years, US CPI has exceeded 4% on 7 occasions, and quality as a style has outperformed in all but one of those occasions. So we believe a quality portfolio is primed to outperform in these type of market conditions. The two best performing stocks in the second quarter were both small mid-cap stocks, one being US Funeral Service Operator Service Corp, which rallied 15%, and also Ritchie Brothers Auctioneers, which is a Canadian-based auctioneer of heavy machinery equipment, which rallied 20%. So both those stocks doing very well, bucking the downward trend of the market. While I was travelling, I did meet with the CEO of Ritchie Brothers Auctioneer, and she really highlighted the excellent opportunity that the business has got to grow revenue in the online heavy equipment auction market through not only growing volumes, but also pricing through a lot of the ancillary services that they provide to their customers. So we continue to see very strong upside in the stock, and it remains one of the larger active positions in the portfolio. During my travels, there were also many key messages that I picked up on from management teams, and the most pertinent being that profit margin forecasts for the second half look too optimistic, and double-digit growth expectations going into 2023 look too high. Inflation is expected to be the major headwind, and as we see the effects of inflation annualise through P&Ls into 2023, that will mean there'll probably be some downgrades to earnings. As we have spoken about previously, we believe that quality companies have far better pricing power to maintain their margins and also give much better earnings resiliency through this type of economic condition. So how do we factor all this in from a trading perspective? Overall, due to the higher uncertainties, we have raised cash by a couple of percentage points. During the quarter, we sold 4 names, one of them being Finnish packaging company Huhtamäki, which was up 7%, so it was nice to sell after a rebound. We also initiated a new position in IDEX Labs, which is a veterinary diagnostics platform maker, where the stock price has actually gone down 50% from its highs in 2021. So we think we've picked up a great bargain in IDEX Labs. In terms of ESG credentials, the portfolio overall retains a very high quality score at over 20% above the benchmark, and also a very good and very low carbon footprint, with the carbon intensity more than 80% below that of the benchmark. Moving to the outlook, as long-term investors, we must look through some of the difficult macroeconomic conditions. Number one, we believe valuation is very attractive. The MSCI World Index is now trading on a 14.5 times PE multiple, looking at forward 12-month earnings. There is that risk of decline in the earnings, but we reduce that risk by holding a basket of high-quality companies that have had that history of outperforming in this type of market environment. We've already started to see a divergence in performance where the high-quality names have really started to outperform some of the laggards. At a portfolio perspective, leverage in the portfolio is also very low. It's 30% below the benchmark. So portfolio companies are not threatened by rising interest rate environment. Additionally, when we look at the profitability of the portfolio, the return on capital is over 15%, which is more than double that of the benchmark. So it shows the strength of these franchises in this type of environment. At this juncture, we hope that geopolitical tensions have peaked. Supply chain bottlenecks are beginning to ease, and we are seeing a retreat in commodity prices. The S&P Goldman Sachs Commodity Index has actually pulled back more than 15% in June alone. So this should reduce inflation outlooks going into 2023. So we don't expect that central banks will have to be as aggressive in interest rate increases as the market currently expects. Given that, we do see an uptick of investor sentiment coming in the near-term horizon. So we're quite positive on the equity markets overall and believe that the portfolio is very well placed to outperform during the second half of the year.